The majority of stock market investors that I've spoken to over the years have told me that they love the idea of someday living off dividends. To most people, there's no greater thought than someday not being forced to work for a living because your expenses are fully covered. Having the freedom to do nothing or only doing what you actually enjoy doing for work is the greatest financial achievement that anyone can attain. Even if you choose not to retire, despite being able to, it serves as the ultimate safety net. Imagine being able to up and leave a job that you don't like without having to worry about your finances. But despite that, a large number of investors who love the idea of living off dividends either don't actually try it or they give up after a short amount of time. The majority of people who would love to live off dividends think that it's simply unattainable for them. They believe that they either needed to have started many years ago or they'll simply never have enough money saved up to do it. The truth is, in our current stock market environment, there are a lot of things working against people who do want to live off dividends. And in fact, from a historical standpoint, it's actually never been harder to achieve this. According to Seeking Alpha, the average dividend yield of an S&P 500 stock as of November of 2024 is a measly 1.2%. If we do the math, we can see that in order to make a measly 40 grand a year off dividends from the average dividend stock in the S&P 500, we would need $3,347,561 invested today. That's obviously a substantial amount of money that's needed in order to live a less than stellar lifestyle. A 1.2% dividend yield is an all-time low compared to the historical average for this index. Many decades ago, the stock market used to offer much higher yields than what we're used to today. The 140-year dividend yield average for the S&P 500 is 4.2%, obviously much higher than it is today. You can see that during the 70s and 80s, the average yield in the market often exceeded 6%. The two main reasons I think for lower dividend yields today are companies putting less of an emphasis on paying a dividend and the fact that so much of the market is currently overvalued. Now, if you happen to be 18 years old and you make over six figures, then attaining $3.3 million in your lifetime isn't such a pipe dream. But the odds are good that this does not describe you and your situation. I'm not here to paint a rosy picture like a lot of finance channels here on YouTube. This is simply unattainable for the majority of people, and most people know this. If you wanted to live comfortably and live off 80 grand a year, then you'd obviously have to double that 3.3 million that's needed. So instead of pursuing what I think is the ultimate passive income dream, many people choose to put their faith in either index funds or handpicking growth stocks instead for their financial future. While these are still good investing strategies, there's never the chance of someday being able to live off the most passive form of income available. You'll still have to rely on selling shares in order to pay for your expenses. And when we someday go through another long period of falling share prices or very dramatic drops, you'll be forced to sell much more of your shares to cover your expenses. The average investor will go through many of these periods throughout their lives, and given the market's recent performance over the last 5 years, it seems obvious that most have forgotten this. Looking at the S&P 500, we've all been extremely blessed with outstanding stock market returns over the past 5 years. And again, based on all this euphoria that we've been seeing, it's clear that the majority of investors have forgotten that there's been very long periods of bad or mediocre performance as well. Between August of 2000 and February of 2003, the S&P did almost nothing but fall, declining by 45% over the span of 2.5 years. The market didn't fully recover again until 2007, which, as you might have guessed, fell again, this time taking 6 years to recover. Imagine selling shares of your index funds or your growth stocks right here when prices fell as hard as they did. So for those who owned index funds or growth stocks during these downturns, you had two options. You could either continue to sell the same dollar amount worth of your shares every month and be forced to eat away at a greater number of your investments, or you would have had to have cut back on your spending. If instead you relied on dividends for your income, you never would have had to have worried about selling shares to pay for your expenses. So what's the solution then? How can someone who doesn't have $1 million saved up achieve living off dividends? It might seem evident, but to receive any worthwhile amount in dividends in today's environment, you have to put your money into higher yielding types of assets. This breakdown that I made shows you how much you would need to invest at certain yields to earn $50,000 per year in dividends. If your dividend portfolio yields 1%, then you would need $5 million. Half of that if your yield is 2%, $1 million with a 5% yield, $625,000 with an 8% yield, and under $556,000 with a 9% yield. The higher the yield, the less you would need to invest. And there are some investments that yield more than 9% that have been pretty consistent. But there's a big issue most people encounter when they're first starting out or if they're just exploring this investing strategy. The issue is that people don't know where to look or even what they're looking for when it comes to high-yielding investments. The term that's used to describe a lot of the higher-yielding stock market investments, like the ones offering these kinds of larger yields, is alternative investments. You're likely familiar with real estate investment trusts, or REITs, which are one example of alternative investments. These kinds of companies do get some coverage from the mainstream media, but there's others out there that exist that offer much higher distributions, and the problem is the major media outlets like CNBC don't cover these types of investments. For example, a great high-yielding type of investment are closed-end funds. When did you last see a closed-end fund get any kind of coverage on Bloomberg TV or any of the other financial networks? How about covered call funds or business development companies? The number of resources out there for these kinds of investments is still lacking, so it's often difficult to find and learn about these high-yielding investments. With some of these alternative investments, they can offer yields greater than 9%, but generally the higher you go in terms of yield, the greater the risk associated with the investment. Some investments do have really solid track records of dividend payouts and yield over 12%. Let's look and see just how exciting high-yielding investing can be and why it's not impossible to live off dividends like you might think. As I'll explain later, I even like to treat this like a game. For this very basic example, we'll use PTY, which is the PIMCO Corporate and Income Opportunity Fund. Imagine for me that you have $10,000 saved up. This could be $10,000 saved up over a period of time, or if you just happen to have this money saved up in other investments or a savings account. I don't think it's a stretch to say that practically all Americans can save up $10,000 over the course of their lifetimes, especially if you're younger. Let's assume you decide to put all of that money into PTY, which is a closed-end fund that yields over 10% and pays monthly dividends. This fund has existed for decades and has always delivered reliable dividends, even during and after the financial crisis. Assuming after investing $10,000 in PTY that you never invest another penny for the rest of your life. The only thing that you do decide to do is reinvest the dividends back into buying more shares of PTY. After 20 years of staying invested, your original $10,000 is earning you roughly $7,316 per year. That's obviously not enough to retire off of, but it's still a good amount off a $10,000 investment. Now imagine if you multiplied everything by 5. If you invested $50,000 one time in your life under the same conditions, you would now be making a little under $37,000 a year. Still not enough to retire off of, but again, a very nice amount of yearly income. But what if you didn't invest just one time using a lump sum? What if you did invest every single month? And what if you invested in other positions, including stocks that provide higher dividend growth, as you should? What you'll find is that not only will you have a lot more money in 20 years, but you won't have to wait that long. This is where I think the fun really comes in. Have a number in mind and view it like a race. How fast can I reach my yearly dividend goals so I can retire? Don't get me wrong, what I'm not recommending here is that you wait until you have a lot of money saved up to start investing. That's not what I'm trying to say here. Putting $50,000 into an index fund and then selling shares throughout the rest of your retirement likely isn't going to last you. But with this example, you're collecting tens of thousands of dollars per year and you're not selling any shares. I hope this video has shown you that yes, you can achieve living off dividends despite not being a millionaire. You just need to hold higher yielding investments and remain dedicated to the process. If you want to learn more about these higher yielding asset types, then click subscribe because the Dividend Bull channel is all about focusing on covering and explaining these higher yielding investments that'll secure your retirement income. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.